Hi, I'm Sarah Kendall. Welcome to InvestorDaily Asset Allocation Week. As part of our special series looking at the outlook for different asset classes, I'm joined today by Schroders Fixed Income Portfolio Manager Mihkel Kase. Mick, thanks for joining us.
Thank you.
Now, first off, I thought it'd be good to just ask about coronavirus, which is a bit of a live issue in markets at the moment. How much volatility do you think this is going to cause, as we go through the rest of the year?
Now, it's been quite interesting because the coronavirus just in the last days sort of has re-hit the headlines, but now it's actually hit risk assets. So overnight we saw equity markets come off, and even today we've sort of seen the Aussie market sort of slightly off for a second time sort of in 2 days. The interesting thing is that this has sort of been building in terms of the noise and the news around this, and a lot of people have expected it was going to follow SARS, but I think now it's moved from the SARS type playbook, if you like, into greater uncertainty around the potential range of outcomes. So we're starting to see it spread to other countries, we're starting to see the death toll rise, but I think it highlights a great amount of uncertainty around the potential range of outcomes. So I think it's really unclear in terms of where we go from here, but I think one thing you can be sure of is that volatility is going to remain elevated, and I think assets, particularly risk assets, if they're finally priced, are quite vulnerable to actually any further shocks going forward. Because remember, the market can only really concentrate on a few things at a time. Last year it was Brexit, impeachment, trade wars. Now coronavirus is front and centre, but lots of risk assets remain relatively fully priced and aren't really sort of looking to the downside. They're still expecting the Fed sort of to be able to sort of pump prime and stimulate the economy without the potential knock-on effect of at least maybe even the short-term breakdown in global supply chains.
And with this sort of economic climate in mind, what considerations are there for income investors looking to construct their portfolio in the year ahead?
Well, the challenge still remains for income investors because we still have bond rates are very low and risk premiums very low. So despite some market volatility through risk assets and different issues driving sort of volatility, if you're an investor and you're still needing to buy assets to try and generate return, you're still basically challenged with you're still facing the same challenge, and that is that risk premium is low, interest rates are low, but going further out the risk spectrum is actually introducing a lot of risk to your portfolio. So whilst we think that volatility will return, we are cautious and we are patient at the moment because we want to see risk premium rebuild before we start to really sort of re-enter risk assets, particularly as we're seeing some investors really chase yield. I think when you've seen term deposits drop significantly, the challenge really is how do I generate income? The temptation is to move further out the risk spectrum, but in doing so, we think people are probably taking on a lot more risk. And if you're allocating out of term deposits and buying high yield debt or other type of assets, you're making a rather large asset allocation decision at this point in the cycle. We think your defensive portion of your portfolio should really be constructed to be defensive. Maybe allocate that over your equity risk budget, but at the end of the day, we'd still think investors should remain cautious and realistic in terms of how much income they can generate in the current environment.
Right, yeah, because that was going to be my next question in terms of, is there, should investors be cautious about moving up the risk spectrum in order to generate income, particularly given that, quite a few of the high dividend equities, with this week's sort of volatility aside, are quite highly stretched in terms of valuations already.
Yeah, I mean, the temptation for some investors is really to say, look, I need to generate a certain amount of yield in my portfolio, and given those term deposits and some of those sort of traditional income securities or income sources have dropped, they might try and back solve and say, well, look, a dividend yield of maybe 5 or 6% actually is going to hit my target. The challenge is, however, that with that higher return also brings potentially higher volatility and higher risk. So we're not saying don't allocate to those, but I would say that be careful in terms of how much you do allocate to them, but importantly, how you allocate. And what I mean by that is that some of those assets actually probably should be allocated out of your equity risk budget. If it has potential volatility like equity, you want to allocate out of your equity risk budget. Otherwise, you end up with a portfolio that's very heavily skewed the growth assets without the defensive component. So we really think that there's sort of like a natural cut-off in terms of what you should allocate in your defensive portfolio at this current point in time.
What about something like hybrid securities? Where does that fit in terms of that sort of, equities versus income sort of?
Yeah, I mean, hybrids are an interesting instrument, and we have been involved in the hybrid market pretty much since it began, and they sit interestingly between debt and equity and have sort of characteristics of both. And we wouldn't say don't use them, but we'd say it's not the sole income portion you might want to have in your portfolio. So, for example, in our absolute return income fund, in our pays portfolio, we actually use hybrids, but it's around about 9%. So it's one asset through a broader global portfolio. So definitely they can be used for income, but be cautious of how much you have in them, and just be conscious that they can be more highly correlated to equities and, for example, fixed income or duration-based assets.
And talking of that sort of global angle, is there an advantage for investors to think global when they're looking at constructing an income portfolio, as opposed to sort of some of these popular domestic income assets, which, you know, may be sort of on the riskier side?
Yeah, our broad view is that you should try to access the broadest opportunity set. Global fixed income markets are larger than global equity markets, and within global fixed income markets you have a very wide range of underlying investments. So everything from cash to government bonds, emerging market debt, developed market debt, high yield investment grade. And being able to use the full suite is really important, we think, in terms of generating return across a different cycle. So for example, if I'm looking at the Australian market, yes, it might form part of my portfolio. Australian investment grade tends to be a low beta asset that provides income, but also too, you want to diversify away from that. So you want to add other credit-based assets. You also want to make sure that you manage the duration component of your portfolio. You know, duration can be a very important risk mitigant. And also consider the use of currency that can also manage downside risk. So we very much advocate being able to access a full global opportunity set. I wouldn't exclude Australian assets, but I wouldn't use solely Australian assets to deliver income across the cycle.
And just moving on to the subject of active ETFs, which have obviously grown in popularity quite significantly over the last few months. What was behind Schroders' decision to launch an active ETF, and what advantages do you think this kind of structure offers?
Yeah. Interestingly, we have seen a proliferation of listed product across the board. It used to be that accessing markets, particularly fixed income markets, was very difficult. You could go out and buy a penny dreadful mining stock, but you couldn't buy a 5-year BHP bond and clip the ticket. Now it's actually probably the reverse. You know, investors are really sport for choice, so they can go out and buy the individual betas of the portfolio, but the challenge is how you blend those. So our view is that it's no longer an access issue necessarily by the investor, it's a portfolio construction challenge. So what assets do I hold, how do I hold them, how do I hedge the exposures, and how do I make sure I have enough liquidity as well? So our approach has been, you know, really what we want to have is an actively managed, diversified global portfolio. And one of the reasons why we bought our new product to the ETF space was that we had an existing absolute return income solution, which we think was very critical in terms of trying to deliver income in a defensive manner. And we just basically introduced the ETF as another access point. The way we've designed it is really basically to interfund into the existing pool, which has had a long track record. But what we really want to do is provide investors with choice, provide our investors and our clients with the opportunity to access a listed space, because we do understand that for some clients, whether it be the annoyance over filling out paper forms, or it may be just better in terms of the way they transact with their broker, that we can actually provide a solution to them that can help solve the defensive income portion of their portfolio.
And looking at the absolute return income fund, how does that get used, I guess, in a portfolio? You said it was sort of a fairly diversified income portfolio in itself, so could investors use that as a standalone solution, or do they need to sort of, you know, mix and match to get a good sort of income allocation?
Yeah, so the way we've designed the portfolio is very much to be a defensive portion of a fixed income portfolio. We've focused on the income component. Now, the way we think about it is it forms part of the broader fixed income component and can be complementary to traditional fixed income, but also could be blended with things such as hybrids. So if you have an existing hybrid allocation, then it would blend quite easily with that. I think the importance of the fixed income allocation is that you do want some duration-based assets. We know that duration is very important, particularly when we get equity market volatility, because it provides good diversification. But we also know that investors also would like to access income, not necessarily with the same interest rate risk. And they may also want to access income without the equity risk that you may get from accessing a dividend stream. So the design is very much complementary to traditional fixed income. It can be blended quite easily in terms of having those other allocations in terms of some of the individual betas or individual assets that you might own. But I think importantly, it's the defensive nature. It does what it says it's going to do in terms of accesses income in low volatility, it can form a portion of your portfolio that can be easily blended with whatever else you have.
And I guess looking at this sort of increasingly competitive ETF space, what do you think differentiates this particular ETF in the market, and what should investors be looking for when they're looking for an active ETF or an active income ETF?
I think there's absolute return space. There's lots of people doing very different things. You might have someone that has more of a hedge fund basis or hedge fund bias that's actually taking lots of leverage, for example, or you might have other people instituting exotic derivative sort of strategies, if you like. Our view is that what we want to deliver is we want to deliver a defensive income stream. We want to do that through accessing credit rates and currency. We prefer simplicity over complexity. So our view is that Schroders as a global organisation has a global reach. We have an actively managed, diversified portfolio that's managed by a well-regarded team and has a long track record. And I think that Schroders as a house has been able to demonstrate the ability to deliver income and fixed income solutions. And I think being able to deliver that in an ETF format for us is very exciting.
Great, so a lot there for income investors to think about and unpack. Thanks very much for joining us today, Mick.
Thank you for having me.